All right, let's dive into Fortrea's latest Q2 earnings. We're talking about the Contract Research Organization, ticker FTRE. And you know, what looked like a fantastic report on the surface, well, it's got a pretty big catch.
So, first things first, what did the market think? The stock absolutely rocketed up, almost 15% in the pre-market when the news dropped. You can just feel the massive sigh of relief from investors, right? But, and there's always a but, that celebration might have been just a little bit premature.
And that really gets to the heart of it, doesn't it? This is the central puzzle we're looking at today. On one hand, Fortrea had what looked like an amazing quarter, and the stock price obviously reflected that. But if you dig just a little bit deeper, there's this one key number that has a lot of people scratching their heads about what's next. So yeah, the big question is, pure relief or is there a catch?
Okay, let's start with the good stuff. Why was everyone so excited? Well, Fortrea pulled off what we in the biz call a beat and raise. It's pretty simple. They beat the earnings expectations for the quarter, and they raised their outlook for the rest of the year. I mean, that's pretty much the gold standard for any earnings report.
And we're not just talking about a small beat here. The size of it was really the story. Wall Street analysts were penciling in about 8 cents for adjusted earnings per share. Fortrea came in and dropped 19 cents on the table. That's more than double what anyone was expecting. A massive, massive outperformance.
And that strength wasn't just on the bottom line. The top line, the revenue, was just as impressive. They brought in over $710 million, absolutely crushing the $631 million consensus. Plus, that's more than 7% growth compared to last year. So the bottom line is, when you just look at the big headline numbers, this was a home run. No question about it.
And this right here really shows you how confident management is feeling. So get this, they raised their forecast for revenue for the whole year, but they kept their profitability target, the EBITDA, the same. Now what does that tell us? It signals they are super confident they can turn their current projects, their backlog, into actual cash, even if the profit they make on that work stays about the same.
So that's the good news, right? That's what lit a fire under the stock. But, like I said, that is not the whole story. Not even close. To really get what's going on, we have to peel back a layer and look at one specific number that kind of throws a wrench in the whole everything is awesome narrative.
And that number is the book-to-bill ratio. Look, for a company like Fortrea, this metric is, well, it's pretty much everything. Think of it like a pipeline. It's the new business they signed up versus the work they completed and billed for. If that ratio is over 1, it means more business is coming in than going out. The pipeline is filling up. Awesome. But if it's below 1, well, the pipeline is draining, and that's not so good.
And here it is. This is the catch. For Q2, Fortrea's book-to-bill was just 0.79. Let that sink in. For every single dollar of work they finished and got paid for, they only signed up 79 cents of new work to replace it. That is a major red flag for where revenue is headed down the road.
Now, of course, management had an answer ready. They were quick to say, hey, hold on a second. Yes, this one quarter was weak, but if you look at the whole last year, the trailing 12 months, our ratio is still a healthy 1.1. So their argument is basically, don't panic, this is just a blip. The billion-dollar question for investors, though, is, are they right? Is it just a blip, or is this the start of a nasty new trend?
So why the weak number? What was the excuse? Well, on the earnings call, management gave a few reasons. They basically pointed to the big CEO change they just had. They said it created a bit of uncertainty, and that made some potential new clients, especially the smaller biotech firms, a little nervous. But, and this is a key detail, they made it very clear that their business with existing customers is still going strong.
Okay, so that brings us to the here and now. The leadership change is done, it's in the rearview mirror. So all eyes are now on the new CEO and his plan. What's the new playbook going to be to get that growth engine firing on all cylinders again?
The new CEO, Anshul Thakral, he got on the call and he didn't mince words. His message was crystal clear. He's an industry veteran, he knows this space, and he said flat out that his job is to add fuel to the growth engine. He talked about bringing energy and discipline. Honestly, for nervous investors, that's exactly the kind of thing you want to hear from the new person in charge. So here's the playbook, the game plan. It's pretty straightforward, really. Step 1, get costs under control to keep profits stable. Step 2, go back and win over those biotech clients who got spooked during the transition. Step 3, the big one, get that book-to-bill number back above 1. And while they're doing all that, they've got this massive $7.5 billion backlog of signed work. That's a huge safety net for them.
All right, so after all that,
what does it mean for the next quarter? This is where we put it all together and give you our take. What should you be looking for on the next earnings call?
Okay, you need to watch 3 things. And really, it all comes down to this. Number 1, book-to-bill. This is non-negotiable. It has to bounce back, ideally above 1. Number 2, we need to see some proof, any early signs that the new CEO's plan is actually working. And number 3, they have to keep delivering on their cost-cutting promises to protect those margins. That's it. That's the scorecard.
So, you want a prediction for Q3? Here you go. We're expecting that book-to-bill number to bounce back to somewhere around 1.0x, just as things settle down after the CEO change. We think earnings per share will probably stay pretty stable thanks to all that cost control. But the stock price, we think it's going to be stuck in a range. The market's going to want to see more than one good quarter before it really buys into the turnaround story.
So, putting a bow on all of this, we're giving Fortrea a market perform rating. Here's why. They're doing a great job on the stuff they can actually control. Cutting costs, working through that big backlog. But that huge question mark hanging over future growth, that weak bookings number, is just too big to ignore. It really calls for some caution until we see proof that things are turning around. It is the definition of a show-me story.
And as always, just a quick reminder for everyone, this is all for informational purposes. This is not financial advice.